We are frozen in time. Every machine in the economy has come to a standstill together at the same time. It's an outlier. It's an anomaly. It's almost a true black swan event. So that's how, yes, it's very different. We have never seen anything like this. But when I do look back in time, there are some similarities. And that's the most important thing to understand, is that, yes, every crash is different. And even though you cannot pinpoint the exact moment that when a crash is going to occur, the stock market crash is a process. It just doesn't happen overnight. It doesn't hit you bam out of nowhere. The recipe is always the same. It's always the same. All you got to take is some unbridled optimism. You marry it with some cheap debt. And most importantly, the human element of hubris. And that's it. That's how, if you look at the Great Depression of either 1929 or even 13 years ago, when we had the the financial crisis of 2008, it was financial innovation and leverage at its best, which caused the crisis. And these are situations which existed even prior to the catalyst of the COVID-19. So that's how it's even similar to the previous crisis.
So how have governments reacted? Like, what did they learn from 2008? And I think you have some insights on 1929. How they reacted differently, and what have they learned?
Well, first, like I mentioned, they have reacted differently because the magnitude and the problem is quite different. It just doesn't require inspiring confidence in people. It requires managing and calming the global human and societal psyche. I mean, we all saw videos. I mean, it sounds funny now, but we all saw videos of people fighting over shortages of toilet paper. There was a serious threat of civil unrest. And this was something which had to be managed immediately. You had to nip it in the bud. So that was something which is commendable, the way governments handled it around the world. And the second problem which we have is the banking system, which is what we saw in, for example, 2008. The liquidity was non-existent. It dried up overnight. And which is what the Federal Reserve, I think, did really well, that within days, not weeks, Arun, within days, they added $1 trillion to the commercial paper market. And the commercial paper market is a market where banks, corporates alike, they go into the market to raise short-term cash for their working capital needs. And that's what the Fed did. It acted as the lender of the last resort. It did what it does best. It printed more dollars and more dollars and more dollars and averted this crisis as well. Or it's done so in terms of just managing, as they say, the liquidity needs.
Mm-hmm. And I mean, if you and I were to print or take on debt, we'd be in trouble pretty quickly. Maybe not you, but I would. But how's the US able to pump in $4 trillion and still get away with it? Isn't there a crisis brewing? Or, I mean, what's the difference between the US and a normal country?
I mean, I think that's again such a valid point. When you that's what worries me. And when I have discussion with my peers, I tell them what we have done is that we managed to avoid the last financial crisis. And I mean, let's start in 1929 when we had the Great Depression. Yes, it took them a really long time to decide that there is actually a crisis happening. And it took them actually 4 years and 3 changes in government when Franklin D. Roosevelt came in 1933 and said, hello. He had to declare a nationwide holiday and announce it to the public that we have a problem. Governments have been swift this time around, which is fine, because on the fiscal end, I think the job has been commendable. You've put in, governments around the world have put in $8 trillion of fiscal stimulus, which if you take as a percentage of the global GDP is 9%, and it's unseen. However, on the monetary side, we have done what we do best. We have pushed our financial plumbing and financial engineering to its very limits. I mean, I'm tired of hearing things like, I don't know about you, but QE and QE2 and QE3, zero interest rates, negative interest rates, helicopter ban, the Greenspan put. What is the Greenspan put? It's just basically saying the Federal Reserve will non-stop, endlessly keep, like you mentioned, keep printing out, keep printing US dollars. And this, yes, is agreed, is unsustainable, because after a point of time, the investors are going to start losing confidence on the Federal Reserve and say, are you really, AAA rated or A-rated because they did have a downgrade in their ratings. So
And
for me, what is worrisome is maybe we have the next black swan event around the corner.
I mean, what could trigger this? What could trigger this? I mean, why would you lose faith in America?
Well,
It's got zero interest rates. They can
exactly.
keep on printing.
Yes.
And so far, people have to put their money somewhere. So far, so good. So what are the risks around this?
I think let me, I answer your first question as you mentioned. Why are people still holding on to the dollar? Why don't they diversify and hold, say, the Chinese yuan or the ruble or the euro? And the reason for that is, if you briefly go back in time to the Bretton Woods conference when the World War II was coming to an end, countries around the world were depegging from and breaking away from the gold standard, and they decided they're going to peg themselves to the US dollar. That's what happened. And since then, we have seen the dollar reserve, maintain its reserve status. And now we have 65% of foreign bank reserves in US dollar. 40% of the world's debt is US dollar denominated. And what could threaten this is all it takes is a change in optimism, a change in faith in dollar being seen as a reserve currency. And what could trigger this? It could be a one-off event. It could happen just at a blink of an eye. Or it could be a process whereby I, as a portfolio manager, and many amongst us, listeners listening in, we've seen, and there's a study by the Bank of International Settlements, whereby they're seeing that the allocation to US as a whole, whether it's a fixed income or it's equities, it used to be 60 to 70% of the portfolio. So portfolio managers around the world were allocating 60 to 70% to America as a region, fixed income and equities alike. Now the trend is going downwards and is ranging from 40 to 60%. So that's a shift as people are looking to diversify. Why is that happening? That's the emergence of emerging markets. And why emerging markets? Well, you have higher yield, you have countries which are starting to do well. In the long term, we have seen the share of, US used to have, let's go back just recently, 1960s, let's say, it was 40% of the world's GDP, but now it's shrunk to less than a quarter. And why is that? Because it's growth of the BRICS, it's the growth of many other frontier market countries which are now coming into emerging markets. So as poorer nations catch up, as the world develops, they are naturally inclined. It's the natural order. You will diversify to your trading partner. So it could be if you trade more with China, you'll hold more yuan. You'll like to keep a diversified reserve base as opposed to just the US dollar, which you've held thus far.
And I have one question from the audience. And they asked, as a portfolio manager, how have you reacted to the situation? What have you done to your own portfolio?
Well, that question, I can answer that, but I try to keep it brief as we do have the next guest who comes in and talks about that as well. In terms of how we were positioned, we had allocated, I don't know if, the listener, is well aware in terms of the allocations to fixed income or equity. But we saw a lot of frothiness in the equity market in the last quarter of last year. And 25% of our equity positions were hedged via puts on the S&P. We increased our holding to gold to 10%. And that was done via ETF. And that's how we hedged it. We didn't reduce our exposure to equities, as we still believe that the areas that we held and the names that we held, they are cash rich, they had strong balance sheets, they were very high dividend yielding names. And even now in an environment where we are seeing, opacity in earnings, people are not sure how long this crisis is going to last. We have seen these companies still maintain the dividend guidance for this year and the next year. So that's how we positioned ourselves. We didn't sell off anything. We had a high percentage of allocation to investment grade on the fixed income side. On the equity side, we were highly allocated to the US, and then to Europe, and then finally to Japan. So that's how we maneuvered the crisis. And I still maneuver.
Great. So I think your time is up.
Okay.
Joao is also probably going to follow up on these questions, and I'll leave you to it. Thank you.
Thank you, Arun. Thanks. Hi, Joao. Thanks for being part of this dialogue today.
Hi, Tanya. Thank you. Good afternoon, everyone.
Joao is a portfolio manager and an advisor at Mirabod, which is a Swiss private bank. His main responsibilities include management of discretionary portfolios, as well as helping high net worth individuals in meeting their investment objectives. And the reason we have Joao, come in immediately after me and sort of to lay and, build the framework for this entire dialogue is portfolio allocation is so crucial. How you were allocated, not now, but 3 months prior to the crisis. And if you weren't, is it still too late? And that's something I want to have a dialogue with Joao about, that what is the impact of Corona on different asset classes? And how have you or any other investor benefited with the importance of diversification?
So good afternoon, everyone. So your question makes all the sense, because I think before we look at the impact of this crisis and the different asset classes, I think it's important as well to look at where we started in the beginning of the year. I think everyone was a bit more bullish. We started off with good news from China and the US trade deal, good news from Brexit as well. So overall, equity markets were performing strongly up to mid-February. Everyone was expecting earnings growth for 2020, and when the number of cases started to spike in Italy and then in the US, I think that's when the market realized that this would have a global impact, and that and so that I think that's when the markets really reacted very quickly. So we saw that equity markets across the world, from the US to Europe to emerging markets, they all have corrected very, very severely. For example, in the S&P 500, we saw that it dropped as much as 35% in a matter of weeks.
Exactly.
But since then, they have somehow recovered, mostly in the US. But still, year to date, we're looking at in Europe, performance, for example, the Euro Stoxx 50 is still minus 23%, DAX minus 19%, in France minus 25%, and in the US, only Nasdaq is positive, around 1.6%, and the S&P is down 11%, Dow Jones 16%, and Russell 2000, which covers the small and mid-cap segment of the market, is on minus 23 point something percent.
Why do you think? Wow, sorry, but I'm always perplexed. Why do you think the sell-off this time? The nearest financial crisis we've seen in memory was 13 years ago, like you and me remember. The sell-off did exist, but it wasn't as quick. The velocity of the sell-off this time around was very quick. Why do you think that was?
I think for multiple reasons. So I think a lot of investors have already profitable positions, so they were happy to take profit. So that's one thing. And I think the second reason for this quick move and these big swings that we've seen in the market, it has to do with ETFs and benchmarking. So I think the amount of assets under management on these ETFs, they exponentialize all the moves in the market. So that's what we've seen. For example, we saw daily swings in the S&P 500 of minus 9%, minus 11%, and then the next day plus 9%, which was unseen almost.
Exactly. And you think if you were diversified at this point of time, that would have helped? Because we've seen every asset class get hit across the board.
Yes, so so myself and Mirabeau, and we are strong believers of diversifying. I guess everyone is, but most of our portfolios are globally diversified and across asset classes. So within fixed income, we have a big portion to US Treasuries and other government bonds. We have an allocation to investment grade, high yield as well, emerging markets. On the equity side, we have exposure mainly to the US and Europe, and then a small allocation to emerging markets as well. And then we always try to have a pocket or an allocation to cash and gold. And as you mentioned before, we also had gold, and we overweight gold in this period. In the beginning, when equity markets started to collapse or to be hit by this crisis, what we saw was that, for example, gold didn't act in the beginning as a safe haven, because we saw a drop of almost 10% in the value of gold. And that was caused basically, I think, because a lot of leveraged investors had to cover their margin calls, because assets or asset valuation were collapsing. They had margin calls to cover. And I think gold, which had already appreciated, so it was a profitable position, it was liquid enough, whereas in other segments of fixed income market, liquidity was not there. So they sold their positions in gold. This had the negative or selling pressure on gold. So we saw gold coming from 1650 to below 1500. But since then it has recovered. And
so
our overweights, for example, to gold, it's a good hedge. Sorry.
Yes. No, sorry. I was just going to come to that point, and I think you answered it well. That's how would you have protected the portfolios? And I was going to say then, your gold and cash position or cash allocations would definitely have helped, during this point of time.
They have, sure. And what also helped was the exposure that we had to US Treasuries, basically, or to government bonds, which have performed. It's probably one of the best performing asset classes year to date. Sometimes for some clients or for some investors, it's difficult to understand, especially clients that like to have big distribution, or they invest for the income. For these clients or for these investors, it's difficult to understand the rationale behind investing in US Treasuries, for example, where yields are very low and the return that you get, or the cash flow or the distribution that you get, is really low. But what sometimes it's not perceptive is that when turbulent times come, these assets appreciate, and they provide not only a hedge, but it's a good hedging instrument as well as store of value and so on.
I agree. And I think to sort of wrap it up, in terms of the current market dislocation and investment opportunities, where can investors look to find? I mean, if there's still any opportunities left in the market, where can we look towards?
I think it depends. It depends. I think it depends on your perspective. Overall, I think we have to remain very cautious too. I think the uncertainty is still enormous. You see most of companies are releasing their results, and they are refraining from providing any guidance, because the uncertainty it's clear. No one knows what's going to happen in the next months and quarters.
Would you say the emerging market high yield space would be a good time probably to allocate to? I mean, they've seen a sell-off, and you were mentioning that last year they had a good rally when we were talking offline. Do you think this is a good time to say it's still a lucrative asset, or is it too soon and people are still holding on, like you said, to holding dollar and dollar-based assets?
I think we would prefer dollar-based assets. As you mentioned, dollar is still strong, and I think it will remain strong, and especially against emerging market currencies. I think probably it's still a bit soon to go into emerging market debt, either local currency or hard currency, and even on high yield space, it has to be with a lot of caution, because there are some pockets that they might have support from the Fed purchasing program, but it's still not certain how it's going to roll out, how the program will roll out that acquisition of investment of high yield bonds, and it's only to a specific term. So I think it's only up to 4 years maturity, and there's a lot of requirements. So buying into high yield, I don't think it's yet the best option.
Okay, and just your final parting thoughts for our listeners today?
I think you still have to remain to look at to stick to the basics. So I think on the equity side, you should look at solid balance sheets, as you were saying, with potentially earning growth, positive cash flow generation. I think those are the big three things that you have to look out for. I think, for example, I was reading this morning, an interesting fact was nowadays when companies are publishing their results, everyone, instead of looking at the income statement, which all the analysts previously were looking at the income statement.
Cash flow statements.
Exactly. So everyone was looking at how sales were growing, what was the earnings per share. Now I think they're looking at the cash flow and the balance sheet. How strong are these balance sheets, and how cash rich are these companies to sustain the next month.
Thank you, Joao.
Yeah.
Sorry for cutting you short.
Yeah.
But thanks for the thoughts, and we'll move on to Arun. Welcome back, Arun. Arun is a seasoned professional. He's currently with First Water, which is a family office that focuses purely on Indian equities. He's previously headed the principal investments team at Icarus, which is a PE fund with over $400 million AUM. So a lot of experience under the belt, Arun. Thanks for joining us today.
Great. No, thank you.
So why don't you tell us that how have you reacted to the fall in the stock market?
Sure. So essentially, I mean, to create alpha, you can't be afraid of your shadow. And there's always something to be afraid of, whether it's attacks or, you're always hearing something in the Far East, some kind of disease and so on. So you have to be a bit immune, effectively, to bad news. But in this case, you have to be a bit more sensitive. So back in January, you were hearing there's some kind of flu going around in China, in a new city you never heard of, Wuhan, and in a province you never heard of, Hubei. And so you just assume it's the same as SARS, the same as MERS, or whatever the stories are. So you just go around your normal time. But obviously, as it hit Italy, it hit Spain, and you could see that these numbers were compounding at a doubling each day, that you suddenly have to react. You have to react to a tsunami. And then you can see that WHO is calling it a pandemic. The US is closing off flights. Countries are going in lockdown. And this was a time when OPEC also couldn't come to an oil deal. So suddenly you've got a tumble, you've got a tsunami in the market, and it's not very easy to be in it. It falls at 5.
This so-called tsunami. You I understand, invest primarily in the Indian equity markets.
Yeah.
How did they react to the tsunami, and which sectors were the most hit, and how were you hit, and how did you respond?
Sure.
Like you mentioned,
so I
it's
mean,
essential to be nimble. Please take us through the process.
Sure. So I mean, initially the market will fall a couple of percent. Then this will just roll up day by day, 5, 10, 20% on some stocks, sometimes 20% on a daily basis. And you're wondering, when is this going to end? So obviously, the moment that kind of, once you sense there's a triggering, like I said, you have to be a bit desensitized in a normal day-to-day, but this is a once in 100 situation, 100 years, something like this happens. So you've got to understand, once this does happen, once you've recognized there is an issue, it's global, and there are going to be total shutdowns in industries, you have to, one, take your winners off the table. I mean, not you, this is what we did. So how we reacted was, we took our winners off the table. We created a cash pocket by doing this. So we had cash in the bank. Secondly, we also have to rebalance. Now, when there is let's say, a fall in the market, it moves generally. But in a situation like this, in a situation when there's a pandemic, when there's total fear, everything moves down at a beta of 1. So investors are throwing out the baby and the bathwater. So actually, so yeah, they're throwing out good stocks, they're throwing out bad stocks at the same rate. So it gives you a good opportunity actually to rebalance your portfolio. Those that are high in debt fall at the same rate as those that are low in debt. So that's what we did. We took out the high leverage companies, which in a normal growing market would actually do well because they've taken out debt, they've had capex, they're looking to expand. But in a situation like this, when there's going to be massive demand implosion and underutilization, you don't want to be leveraged. So we were given that opportunity. If they were both, let's say, negative 30%, we were given that opportunity to get out of that had heavy leverage into that was cash rich. So this is about, let's say, capital preservation. So it's very hard for a company to go bankrupt if it has no debt. And those are the companies that we were looking for.
I see. And I understand that you tend to generally, I think, as your investment philosophy, you tend to focus on value companies.
Yes.
And I guess it played out rather well for you vis-a-vis the growth stocks?
No, I mean, not necessarily. Value is now better value. Everything is undervalued in general. So it's not a matter of growth or value. You're just getting better value. So again, this goes with our philosophy. We never invest, let's say, the entire car kit and caboodle in one shot. We invest on a staggered, sipped basis. So again, you can average into the market. And this obviously has played well because the moment you invest all your money, then you're speculating. You're speculating that this is the bottom of the market or it's not going to go lower than your pain threshold. But because we stagger in, we average in. So we still had cash in the bank on top of the winners that we sold out. And the sectors that we followed hard assets because a time like this, when there's a demand implosion, liquidity crunch, everything in one shot, financial crisis possibly, those that have had poor corporate governance that have been, let's say, plugging the holes in their book.
I'm going to interrupt you and ask you a rather silly question. What is a hard asset?
So it's something like a manufacturing firm or a company with hard fixed assets, capex.
As opposed to technology companies where you don't have any physical assets.
Whether it's tech, financials, insurance, all very light asset companies. But especially in finance, you don't know, unless you do a deep due diligence, you don't know how real is this book? Is it just plugging in? Is it relying on short-term debt to ensure that it's just ticking over or raising more finances? So in a time like this, when the financial markets have frozen, it won't be able to continually plug in. So this is when the tide is going out. And you're going to find out who's got serious corporate governance issues. But in a hard book, you can kind of correlate its output, its revenues to its book and to its machinery. So there's a bit more, let's say, grounding in from the balance sheet to the revenues.
So when you mentioned, physical assets, and these are companies with machinery and so on and so forth, how, compared, say, to a 5-year or even a regular 1-year average, what is the capacity utilization, of machinery and these companies as of now? Are they at a complete standstill? What's the situation like for these companies? Because manufacturing is the heart and soul of any economy.
Yes.
So it must be hurting these stocks a lot.
It depends, again, and this is where we balance our portfolio towards, because you're right, there's been a complete shutdown, whether of staff, of workers, and so on. But there are some industries, and again, in India, the government was a little slow to recognize what is an essential product. So obviously FMCG, food, agriculture, these are essential products. But there's also other products down the value chain that were shut down, but then restarted once they gave their case. So yes, when you're an essential product, you are running at sometimes 100, 110%, because you are essential and there's a demand pop, whether it's FMCG or plastics and packaging and so on. So clearly these guys are running, but if you're unessential or you have, then you're at a complete shutdown, whether it's the auto industry. So you don't want to be in that space because you don't know what is going to be discretionary spend after the corona and after lockdown ends.
Mm-hmm. And where do you see, so in terms specifically when let's talk about India, where do you feel they will focus their economic stimulus or they are focusing their economic stimulus? And are you, as an investor, are you happy with the way things are, unraveling, so to speak?
No, because India still 45 days on hasn't done diddly squat. So I don't know whether they're just figuring it out themselves or whether they're speaking to experts. But yes, from a financial perspective, the RBI, which is our central bank, has been very responsible, lowering interest rates, creating credit lines for banks, for NBFCs, which are non-banking financial institutions, creating a whole bunch of not stimulus, but a safety net for the financial system. But clearly, there's a difference between a safety net and an economic stimulus, where you've suddenly got a demand implosion. So you have to create demand. The government has to say, I'm going to, like the US has said, I'm going to issue 4 trillion. I'm going to invest. China, every time there's a slowdown, it invests in infrastructure. It creates demand. It creates jobs. So where I'd imagine, or one would hope, the government should be looking at are those that are economic and employer or employee multipliers. Things like infrastructure, whether you build roads, new cities, special economic zones, and also textiles. Textiles is one of the key employee multipliers. Every a few $1,000s, you're creating 10 jobs in the apparel industry. So it has to really focus on businesses that will create employment and create demand. And for instance, like I said, construction, 1,500 industries lead into construction: cement, steel, packaging. I mean, not packaging, cement, steel, aluminium, EPC. All these flow into it. So it demands from other industries.
We have a question just come in, and I think that could also be your parting thought. It's an excellent question. Do you think there's an opportunity for India to pump up its trade export now, considering the decline in confidence with the Chinese export and supply chain?
I mean, it has to. I mean, it doesn't have a choice. India is hampered by its bureaucrats, its government, but it has a population. It has a smart population, an educated population, and it has a huge domestic demand. That is the key. So clearly, there's several triggers now. So China, already there was a trade war prior to this crisis. Already people were thinking, Trump was blowing his trumpet and saying, if you're in China, I'm going to penalize you. So, manufacturing units were saying, where do I re-go? Where do I reallocate reset up my business? So they're looking at countries with where would you go if you're a manufacturing unit? You want to offload your goods where there's a strong domestic base. And we're bigger than India, Indonesia, Thailand, Vietnam. Here you got big populations that will offload a lot of your product, and then the rest can be exported. So that was the easiest play. Secondly, unfortunately, there's an anti-China sentiment. So that may play into the baton from China to India. Thirdly, China has moved up the value chain. Its wages are now more expensive. It's also looking at the environment. As you become a richer country, richer by GDP per capita, you become more.
Sorry to interject, but the point about environment in China is out of necessity, as fossil fuels are they're non-renewable and they are exhausted. It's a scarce resource. So when you see, I think, which probably our speaker Jessica will also probably touch upon, is the fact that China is such a huge economy in terms of mouths, just as a simple metric as mouths to feed, that when your resources are scarce and you're running out of oil, you're running out of fossil fuel, coal, etc., what do you look at? You look towards solar energy. You look at any other alternative source of energy, like you mentioned. So I think it's more necessity being the mother of invention as opposed to just a luxury.
Sure.
Thanks. Sorry, go on.
Sure. So no, that wasn't my point. My point was really manufacturing. sometimes in chemicals and specialty chemicals and refineries. They're dirty energy, they're dirty businesses, they create pollution. But now China is green belting its industrial zones. As you said, there's a lot of pollution. So where are these guys going to go? India has a great chemical business, pharmaceuticals, all these things. And because we're a poor country, we should and will hopefully, grab it with two hands, this opportunity for businesses to relocate to India. And that's the story. So, I mean, I know you're trying to shut me up, so you can if you want.
Well, I tried. There were 2 unsuccessful attempts. Third time lucky, I guess. No, just jokes apart, Arun. Thanks a lot for sharing your thoughts. And do stick around for the Q&A. I think we have quite a few questions probably towards the end as well. Next up amongst us, we have Rajat Malik. He's a certified architect and he holds a master's in urban and regional planning studies. He has more than 8 years of experience under his belt, primarily in the real estate investments in more than 15 countries. So I think more than myself, a lot of other people, we are happy to have you on board and on this panel, Rajat.
Hi, everyone.
I guess the first step would be the question that I'm asking everyone is the impact of COVID-19. What's it been like for you as a real estate investor?
I mean, things have stalled. So, I mean, it's not real estate as an asset class is not as liquid as, let's say, stocks or other assets where sort of fluctuations happen. So currently it's a freeze situation. Everyone is frozen. We are carefully looking at impacts on each asset class and region. So it remains a very local industry. I mean, the demand remains very, apart from a few asset classes, it remains a very local. So the impact on, let's say, Dubai would be very different from London. The impact on office space would be very different from how hotels are impacted. So I think it has to be looked at in conjunction with these factors. So geography, asset class, the dependency, the demand profile of that specific. So hotels, there are cities which are dependent completely on domestic demand, vis-a-vis a place like Dubai, which is has a substantially higher percentage of international travelers. So the impact and the recovery scenarios for each market would be very different. And so I'll start with how real estate is owned. So we can broadly sort of categorize this as individual investors, which are basically people like us buying homes, buying small shops, but primarily residential is so you can buy a villa, apartments. So that's one group of investors. And the second are institutional investors, the private equity firms, the sovereign wealth funds, sort of buying hotels, office parks, and the large sort of commercial income generating assets. So that's broadly the two categories of real estate. I would like to get into each asset class and see how the demand is changing. Okay. The valuation, the change in valuation will come in months, when we actually see transactions happening. Currently, just by the nature of the way real estate is transacted, there is a long due diligence period. Then there are regulations regarding how do you get in. So it's pretty long. So we have seen the deal pipeline suddenly sort of frozen for the time being. It will start opening up in the coming months, but the impact on valuations, it's very hard to guess. But across the board, there is a sense that 15 to 20% is normal. It might be far more in markets like Dubai, which were already suffering through an oversupply situation.
So let's start, I guess, let's start step by step. Let's start, as you mentioned, it's good to define it. Firstly, like you mentioned, whether it's corporate real estate, hotels, and then downtown versus suburbs. And then at a geography level, let's start at a macro level, at a global level. When you're looking at the corporate real estate space, how would corporates, like you mentioned, balance their operational costs, well-being and productivity as of now, and how are they doing it?
So like we are seeing in Dubai, in Abu Dhabi, and a lot of global cities, there are local sort of regulations coming in, both from the regulatory side and corporates, both that there should be a minimum amount. They're defining the square feet per person. So that eventually would lead in lower density inside offices. So currently we see packed offices with open plans.
Exactly.
That might be reverted for a long time. So currently, I mean, for the short time, of course, I mean, you won't see more than 30-40% of your workforce in offices. But even in the long term, I mean, there's an example of Tata Consulting Services, which has given some figures. I mean, I'm not sure how accurate they are, but they're expecting 25% of their workforce to be, only 25% of their workforce at any given time to be working off their campus. So there are corporates who are looking at taking this trend of working from home into a long-term pattern. So that will definitely impact the amount of real estate that they are absorbing, the corporates are absorbing. So currently, if a company is absorbing, let's say, 100,000 square feet, they might be looking at cutting that down to 60,000 square feet. So that's a substantial long-term change. The other change, of course, is if there is economic downturn, we will, of course, see a down in the demand for office space.
But then, like you mentioned, corporate real estate are usually longer term leases, like 6 to 9 years.
Yes.
So you wouldn't see the impact immediately because they're already locked into contract. Like you mentioned, the occupancy will be much lower as opposed to 100% occupancy. Do you think that they're starting to factor that in already, and it's a long term trend?
So short term, I mean, we are seeing corporates asking for rent waivers, a mixture of rent waivers, sort of cutting down on their rent immediately. In the long term, we could see a mix of both. One, they could cut down on their appetite for office space. The second could be they could renegotiate these long-term leases. But that's still to come. I mean, I don't. It's definitely come for co-working spaces like WeWork, where companies were locked in, startups were locked in for a very short period. They are definitely seeing they've already seen a sudden decline in their demand for office space. But longer term, I mean, it'll take a couple of months to sort of really get to know what will be the long-term trend, or what will be the new normal.
Before we get into hotels, we have a question from the audience. They say real estate seems to be crashing market in terms of workforce, which has suffered the most in Dubai, say, for instance. What's the future for the developers who are launching so many off-plan projects? Will this fizzle out for the given year?
If it's specifically for Dubai, I think it's the whole impact. I mean, I think we had that discussion on the group also. So if you add up the impact of oil prices, Dubai has already seen a correction of close to 30% in both rentals and values over the past 3 to 4 years. From a 2014 peak, they have been seeing a downward trend. Everyone was hoping 2020 would possibly change something, but they were in an excessively oversupplied situation. Now you add negative migration because of job losses, the oil prices, and this COVID situation. So the future does not look very nice in the short term until and unless there is some sort of a policy. Residency was one policy which was being looked at, some sort of revive that could possibly revive. It has happened in a lot of European countries, which linked residency to property purchase. So some sort of land, something as substantial as that could revive the market in the short term. But looking at the situation, it looks a bit bleak, at least in Dubai. I mean, that's global, but Dubai and markets which are reliant on international investors, heavily on international investors, they could see a more accelerated impact.
So then again, I guess when we're talking about Dubai, let's say something closer to home, and given that hospitality and tourism is one of the major contributors to GDP, so we are expected. You think hospitality and the aviation industry will see or sustain a prolonged lockdown then?
So hospitality outrightly has been the worst hit in the short term. I mean, retail, of course, but hospitality, they haven't seen anything like this ever. There were comparisons to 9/11 and the financial crisis, but that's not even close. I mean, I think in April, or the impact was already 10x of what 9/11, the impact on tourism and air travel, as if we compare it to 9/11. Now, 9/11 took 15 months to sort of come to pre-9/11 levels. But this, we honestly don't know what kind of, I mean, if you talk to the tourism guys, you talk to the hospitality guys, they are bullish. They are like 2022, we might see a rebound and things could revive to 2019 levels. But it could extend depending on how restrictions are lifted. It heavily depends on how do countries sort of start lifting their travel restrictions. But there definitely will be a chunk of demand that will be gone for a short to medium term.
Okay, and I guess some final thoughts with some questions from the audience. One question that we have is, what were the performances on some of the international REITs? I mean, if you're looking at this,
I won't have too much on REITs. Yeah.
Okay. Then I guess if you could just talk about how Expo 2020, I guess we've seen an impact. It's already been moved. It's now probably Expo 2021 or 22.
Yeah.
We have seen an impact there, and also I guess the same situation would be when you compare downtowns versus suburbs. Will the prime downtown hold the same value post-COVID, or?
Yeah. So I think this argument of downtown versus suburbs is more global, because when historically, I mean, going back to whenever there have been pandemics and people have, and especially the wealthier lot they've been resistant to get into crowded places. So I mean, there has been last 10, 15 years, there has been a growing attraction towards denser downtown, more central locations, primarily due to access to work and amenities, because you want to be close to where the good restaurants are, you want to be close to your work. Now with that changing, and this perception that in crowded places you can catch diseases, that might start changing, and people might start looking for places which have more open spaces. The size of the house, it's really amazing. The average urban house, the size has gone on drastically over the last 10-15 years. Now we might start, if work from home becomes a trend, if virtual classes for students becomes a trend, we might start seeing the demand in the individual big homes. But that, of course, is closely linked to how many people have jobs and how does the economy do again? How many people have disposable incomes to buy bigger homes? But in terms of value, we definitely see the suburbs, but it's again a demand shift first, and then that'll impact values.
And then on that same line of thought, you would say that commercial properties are not attractive investments, but residentials would be a better option then?
It's again hard to say. It depends on the valuation. Commercial property, definitely all three. If we call office, retail definitely would be massively hit. Hospitality in the short to medium term, definitely, but we have assumptions that might pick up. Office again. So these three clubbed together, the valuations they currently are definitely not a good investment. But residential, we could see, depending on the it would depend on the micro market again. It's again, is it Dubai? Is it London? Is it which part of the world is? And what is the supply situation there? If you have thousands and thousands of units planned for the next 2 years, then it's a bit hard.
Thank you so much for your time, Rajat. We'll move on to Jessica now.
Thanks.
Hi, Jessica. Jessica is a sustainable finance and responsible investments expert. She has worked and is currently working as a strategic advisor to institutions, think tanks, and governments. Her previous role was as head of Asia for the UN supported Principles for Responsible Investment. And I'm really excited that she's part of the panel today. Jessica, just to get started, climate change, remains a key investment risk. Why has climate change become such an important investment consideration? That many are claiming is impossible to ignore. Should we be thinking that maybe climate change will be the next black swan?
Sure. Okay. Well, thanks, Tanya. Yeah, I mean, as you said, I've been in this space, sort of sustainable investing, climate finance space for about 14 years. So I'm actually considered quite an old timer, given how new the field is. It's very clear that the large institutional investors essentially consider climate change to be a key investment risk now. Now, that only really has happened in the last sort of 3 or 4 years. But I do want to make very clear that it happened before the pandemic. That said, it's important to recognize that the pandemic and the economic downturn is going to have an impact on the climate conversation, but it will not change that investor imperative. Actually, for many investors, what we're seeing, they're coming out and arguing that it makes it more urgent that we take action on climate change because of what's happening in the world today, largely because it's teaching us about the need to prepare and prepare for and mitigate against these kind of global impact events. Certainly in the short term, we're going to see emissions drop. The International Energy Agency came up recently and said that emissions are likely to drop by around 8% this year. And certainly that's the largest drop in the last 120 years of records. But I think it'd be very foolish to think that's going to be permanent. Really, to put it into that context, we're looking at needing that to happen, that drop to happen every year this decade to have any chance of reaching that 1.5 degree increase in temperature. So just on the investor perspective on climate change, we know that it's become very important because we're seeing the dialogue happen at the mainstream level. For example, you've got the Climate Action Movement, which has over 450 investors who manage AUM of $40 trillion US. We've got, as the UNPRI, the number of signatories are really taking off. Asset owners from around the world are signing up to responsible investment strategies. We even had Larry Fink come out earlier this year in his annual letter and said that BlackRock would be exiting certain investments with that high sustainability related risk, particularly coal. And then of course the central banks are taking action. Mark Carney has become very well known at his time at the Bank of England, warning that unless firms wake up to this climate crisis, many assets will become worthless. Now, I really think the turning point for this was the Paris Agreement, which was signed in 2016. And because of the global commitment that made to reduce emissions, basically targeting net zero emissions by 2050, it's given us a carbon budget. Now, a global carbon budget is essentially a very simplified way to measure the additional emissions that can enter the atmosphere if we want to keep on the trajectory of a 1.5 degree increase in temperature. Now, the thing about 2016 was finance and the financial institutions were at the table because it's well recognized that the amount of investment that's needed is absolutely massive. So we're looking at something between 1.6 trillion and 3.8 trillion annually through to 2050 if we're going to keep on track.
Do you think these investments, which were on track prior to this healthcare pandemic, what's happening in terms of the role that sustainable finance is playing in these recovery years? And do you think the allocations will still continue to remain on track, or does that mean that the allocations which were made for something which is still seen as a secondary or a tertiary investment are not still primary? Unfortunately, no, I disagree with that. I disagree with that. But do you think maybe some allocation might be taken away?
No. So actually, and as someone who's worked and lived in pretty much every region in the world, I think the dialogue that's happening in the Middle East is not at the same level as happening in Europe, Asia, and I was in China for many years, and even North America. I think this sort of touches on the black swan discussion, because I don't actually think we can argue that, because we already have big institutional investors at the table. They're worried about stranded asset risks, financial stability risk, the business risks that are associated with the low carbon transition. We've got corporates are taking big action. So you'll have seen, BP, Microsoft, Nestle come out and say, we're going to hit net zero emissions by 2050 as well. So I think we're all moving in that trajectory. But I think what we're now seeing, and during, as we sort of are now talking about the recovery plans of how we move out of this pandemic-related downturn, the debate that's what is happening is, sure, of course, the priority is around lives and livelihoods, but we're also talking about how we can actually focus on environmental issues, focus on climate change, and rebuild our economies so we strive to avoid the next crisis, which many scientists and many economists are assuming is going to be climate change. And I think one of the interesting things out of that has been that previously, particularly on the right side of politics and political debate, was that policies tackling climate change were quite often seen as stifling economic growth, but that's fundamentally shifted. We now see big asset owners continue with their allocation to green, to low carbon, to ESG type assets. And you know, having seen the dialogue that's been coming out over the last couple of weeks, you know, there's been no indication that people are withdrawing that portfolio allocation at all.
You know, I can follow up and complement what you mentioned about Larry Fink of BlackRock pledging certain allocation to ESG, companies with high ESG scores. We had the same sort of announcement and a strong, if you can say, signatory moves coming out of the Norges Bank, which is the investment management arm of Norway and one of the largest sovereign wealth funds in the world, which derives most of its income from petrodollars. For them to come out and say, we will start allocating only to companies which have high ESG scores, I think that says a lot, like you mentioned, in terms of the shifts that we're now seeing.
Yeah, and I think it's really interesting to consider. You've got sort of the regulatory and policy environment. So the EU has said very clearly, we're sticking to the Green Deal. And they've said that over the last couple of weeks. We're looking at the stimulus packages that are coming out. And actually, a lot of these stimulus packages are very much focused on green, low carbon. I won't talk about the US at this point on that. But on the private sector side, we've got asset owners with their continued commitment. Every day I'm reading about new products that are launched. So BlackRock just launched a 430 million unconstrained ESG bond fund. So they're not pulling back. Even in the UAE, Dubai Financial Market launched very recently the UAE Index for ESG, again, demonstrating this ongoing commitment to sustainable finance. The one thing I just wanted to say about given where we sit here and oil, and I know that's very topical with this group, but when we look at the energy transition, so we talk about fossil fuels to clean energy, what we've seen with the oil price crash, and probably historically, many people assumed that when the oil price dropped, actually there would be a strong argument not to move forward with clean energy. But interestingly, this is now no longer the case. So even last week, the IEA issued a report and actually said, okay, multi-decade lows in the world's consumption of oil and gas, but renewable energy continues to grow. Sure, it's really early days, but the investors are actually still focused on renewable projects that offer that price and earning stability, which is actually quite welcome in this recovery environment.
And we have a question from the audience. Clearly an engaging conversation. They mentioned that there was an article from the United Nations warning of a hunger pandemic. What are we seeing in food security, and how are the governments acting? If that's within your purview.
I mean, I have to say, so, and actually possibly this links to, it's talking about ESG and what's happened in the ESG world. And as we know, ESG has been it's been a huge buzz over the last 2 or 3 years. We know now that ESG issues have a material impact on investment performance. And there are lots of things that have happened in the last month, given the pandemic, that have influenced the ESG debate. Obviously, I've just spoken about the environment and climate, but also the important thing is how our sort of definition of ESG is evolving. And this has meant an increased focus on social issues, which before was very much more about environment and climate, largely because that's much more measurable. But now we're starting to look at broader social type issues, because we see the deep linkages between the businesses we invest in and the different stakeholders across those value chains. So from an investor perspective now, the social risks such as health, safety, equality, workforce dynamics, all seem to be very much in focus. And I think that's been a really interesting step change in the last 4 to 6 weeks. On the food security issue, it's probably outside of my scope of specialism, but what I can say is that investors are becoming more comfortable when talking about social issues in their portfolios, which I think is a great development, actually.
And I guess to probably wrap up this conversation is let's talk about the emergence of social bonds as a response to the pandemic. Exploring an example of how investment priorities may be shifting. Let's talk about like we were speaking offline about the recent emergence of social bonds. Yeah. What have we seen in this space? What's new, and how do we see this market growing?
Yeah, so again, green bonds, you'll have all heard about the excitement about green bonds. Massive growth. I mean, comparative to the bond market, very small still, but massive growth over the last 5 years. And that's not going to go away. HSBC has clearly said the last few months demand has dropped, but it's going to come back. Now, what's been interesting is that this interest is also shifting to the social bonds. And in fact, HSB projected as much as 125 billion in 2020, which is a big surge when you look at social projects that are coming out because of the crisis. The International Capital Market Association has come out with a whole series of definitions around what a social bond is, what it would look like. Again, use of proceeds, the process for project evaluation, management of proceeds, and so forth. And then what can be included are things like COVID-19 related expenditures around healthcare services, medical research, loans to SMEs. So again, it's, there are these sort of industry innovations that are really coming out as we respond. And I think actually, if, from a long-term investor perspective, it's really exciting. One thing I do want to add is, because it's been quite topical, is a lot of people ask me, what are we seeing in terms of performance? So ESG funds, where are we seeing, how are these performing? And of course, it's super early days, right? So the data is very, very fresh and very limited, but we've had MSCI come out and compare its ESG indices, and actually saying the SRI index has shown the strongest performance. We've had Morningstar looking at equity funds, 2/3 of the sustainable funds outperformed their average peers during March. And then recently, AXA Investment Management did a whole load of research on bonds and shares of companies with higher ESG ratings. And it seems that these have proved more resilient. So to your point around, are we going to reduce our allocations in the portfolios? I actually think we're going to see investors actually step up, because not only is there sort of increased drivers around things like impact shocks like climate change, social bonds, social investment opportunities, but we're also seeing resilience in these types of investments. And I think that's something we really need to think as we look forward.
To avoid the next black swan, per se.
Well, I mean, as I said, I think we know the writings on the wall with climate change. Even the oil majors know that, right? We have the data, we have the science. So if we're not doing something about it now, if we're not reviewing our portfolio exposures, then maybe you're in the wrong game. Okay,
thank you, Jessica. Thanks for your time. Now we'll wait for some questions to come in. It's the Q&A hour. We'll open it to any and every questions that we have, and then we'll ask the speakers if the questions are directed to them. Okay, I have one question coming in for you, Jessica.
Sure.
Are there any increased commitments to green buildings from corporates?
Do you mean, yes, absolutely. Long-term investors, yes. In the short term, I don't know, but yes, absolutely on the green building side. We see this particularly in sort of, intense, highly populated cities like places like Hong Kong, where I used to live. Yes, we are. And I think the other important thing to remember here is we're having this discussion across in the background of discussion on the global price on carbon, and I think that's going to impact, once the inevitability of a carbon price comes in, which I think is going to happen. It's going to sit across all of these different asset classes, buildings included. So it's not just going to be aviation, energy producers. We're going to see it across buildings, retail, all the different sectors. So yes, I am seeing that.
I think that's about it. We have not seen any more questions come in. Thanks all the speakers for your time, and for the listeners who did dial in. The next in the series, we'll have some venture capitalists, some private equity firms, a CEO of an insurance company, and also a family office, which has been through the 2008 financial crisis and is going through now the next financial crisis just 13 years hence. So we'll keep you in the loop. Thanks for joining us today. Have a good evening. Bye.
Bye.